So for the investment appraiser, they can ask you questions on so many options. They can ask you questions on asset replacement when a company. How often should a company replace an asset? They can ask you question on lease or buy. They can ask you question on sensitivity analysis. They can also ask you a question on what we call capital rationing. A situation where the company wants to undertake so many projects, but the funds are not there. Or they can also ask you questions on a normal investment appraisal technique, which can be the NPV with inflation, NPV with issues of capital allowance and other issues. Or they can also ask you a question on the internal rate of return, accounting rate of return, and they can also ask you a question on payback period or discounted payback period. You just have to revise those ones again. But we are going to be picking questions on the few of them, and we see how we can go about each of them and see the way forward. Let's look at question number 1, which is on asset replacement decisions. Who is helping us to read that? Yeah, who is helping us to read that?
Okay. So I'm reading.
Okay.
AL Limited is a manufacturing company based in Aba. One of its most successful products is Hardtone, a mortar coloring agent. Hardtone is made using a single processing machine which mixes the raw ingredients and dispenses the completed product into 5-liter cartons. A 5-liter carton of Hardtone sells for $300, and estimated maximum annual demand at this price is 300 cartons. At this level of demand, AL can justify the operation of owning one processing machine, which AL currently replaces every 3 years, although the processing machine has a productive life of 4 years. In the first year of its life, the processing machine has a productive capacity in line with the maximum annual demand for the product. But each year thereafter, this productive capacity falls at a rate of 15,000 units per annum. Annual maintenance costs in the first year of operating the processing machine are estimated at $300,000 US. Thereafter, the directors expect the annual maintenance cost to increase by $50,000 per annum, regardless of the actual number of 5-liter cartons produced. AL incurs variable cost, excluding depreciation and maintenance cost of $200 in producing each 5-liter carton. AL provides for depreciation on all its non-current assets using the straight line method. If AL were to dispose of the processing machine after 1 year, the directors estimate sales proceeds of $8 million, but these could fall by $3 million per annum in each of the following 2 years. Assume the processing machine has 3 years lifespan. Following a recent increase in the cost of processing machine to $12 million, AL's directors are reconsidering their current replacement policy with a view to maximizing the present value of the company's cash flows. It can be assumed that all revenues and costs are received or paid in cash at the end of each year to which they relate, with the exception of the initial price of the processing machine, which is paid in full at the time of purchase. Required. Assuming that the processing machine is used to maximum capacity and showing all your supporting calculations, advise AL's directors how often they should replace the processing machine. Assume cost of capital of 10%. Itemize the major assumptions made in your calculations above.
All right, thank you, sir. Okay. So this question is about assets replacement decision. Okay, which is very simple if you come to this one. We always use the annual equivalent method. Okay, let's come here. They are asking you to know how often the how often the company should replace the assets. They are thinking about every 3 years, but looking at how things are going, they are so they are asking you to advise them on the replacement policy. So how often should they replace their assets? Okay, do we know how much they are purchasing the processing machine? Are we giving the amounts that they are purchasing the processing machine?
Yes, 12 million.
Is that so?
Following recent increase in cost of processing machine.
Okay. Let me come to replacing. Replacing every year. Okay. Let's come to this one. Let's say following a recent increase in the cost of processing machine to 12 million. Does this mean that this is the amount that they purchased the machine? Is that the purchase price?
I'm thinking it's a 300 times the 300,000.
No, those are maintenance costs. Okay. The machine has already been purchased, and we are not going to be incurring any purchase cost for this machine, because the question is that following a recent increase in the cost of a processing machine, following a recent increase in the cost of processing machine, AS directors are reconsidering their current replacement policy with a view to maximizing the present value of the company's cash flows. So we want to be replacing the machine every 3 years, but the current cost of the machine now in the market is 12 million. It doesn't mean that we are going to be purchasing the machine now. No. So following the recent increase in the cost of a processing machine to 12 million. Okay. Following the recent increase in the cost of a processing machine to 12 million, AS directors are considering their current replacing policy with a view to maximize the present value of the company's cash flow. So it's not now that you are going to be buying the machine, the company using a single processing machine, which mixes the raw ingredient and dispenses the complete product into 5, this one. Okay. An estimated annual demand at this price is the price of a 5-liter carton of hard tune sells for 300. Okay, this price is 300,000. At this level of demand, AL can justify that the operation of only one processing machine, which AL currently replaces every 3 years. Although the processing machine has a productive life of 4 years. In the first year of its life, a processing machine has a productive capacity in line with the maximum annual demand for the product. But each year end thereafter, this product capacity falls at a rate of 15,000 units per annum. Annual maintenance costs in the first year of operating the processing machine are estimated at 300,000. Thereafter, the directors estimate that the annual maintenance cost to increase by 50,000 per annum, regardless of the actual number of 5-liter cartons produced. AL incurs variable costs, excluding depreciation and maintenance cost of 200 in producing each liter carton. AL provides for depreciation on each non-current asset using the straight line method. If AL were to dispose of the processing machine after 1 year, the directed estimate sale proceeds of 800, but this could fall by 8 million. This could fall by 3 million per annum in each of the following years, assuming the processing machine has 3 years. Okay. Following a recent increase in the cost of a processing machine to 12 million, AL directors are now reconsidering their current replacement policy with a view to maximize the present value of the company's cash flow. It can be assumed that all revenues and costs are received or paid at the end of the year to which they relate, with the exception of the initial price of the processing machine, which is paid in full at the time of purchase. Okay, let me okay. So let's look at this assumption over here. In the first year of its life, the processing machine has a productive capacity in line with the maximum annual demand for, which will fall at this. Okay. Annual maintenance costs in the first year of operating the processing machine are estimated at 300, and the directors expect the annual cost to increase by 50,000. The AL incurs variable costs, excluding depreciation and maintenance, in producing each 5-liter carton. AL provide depreciation of this and this, and So AL currently replaces every 3 years, although the processing machine has a product life of 4 years. Okay, so if you purchase this, the estimated annual cost is the estimated annual cost is this figure, and this is estimated to be this one. Provide for depreciation, assuming the processing machine has 3 years. Okay, following the recent increase in the cost of processing machine two, so the cost of processing machine directors are reconsidering their current replacement policy with a view to maximize. Okay, all right, we need to buy the machine before we can use, but since there is no amount or there is no information given on that, then it means that we have to buy the machine now at the 12 million. Okay, so you can use the 12 million at the purchase price of the machine, because there is nothing given to us over here as they are having existing machine and the price that it has been purchased at. So all this information given to us, we need to purchase the machine first before we need to purchase the machine first before we start the production. So it can be justified that the current cost of the machine or the purchase price of the machine, which is the recent increase in the cost of the processing machine to 12 million, we can say that, okay, they have to purchase the machine before they can use it, because the question is not giving us any information about they having existing machine which has been already purchased, and we use that as a sunk cost. So since there's no information, then the 12 million will be okay for that. So let's use this, our years over year. So we have the cash flow, we have the discount factor, then we have the present value. So we are replacing every 1 year. Okay, so replacing every 1 year. Let's look at what we are going to be having. Replacing every year. Okay, let me just, every year is also same as every 1 year. Okay, so if you are replacing every 1 year, you still have to purchase a machine at the 12 million given to us. Okay, then a discount factor is supposed to be 10%. You are paying now, so this will be 1.00. Then multiplied by the still the cost of 12 million. Okay. So still the cost of 12 million. Okay. In the first year, what is the cash flow that we are going to be receiving from the usage of the machine? Okay. Let's go and do workings for those cash flows and come. So this will be, let me take this one off so that I can divide the board into two. So okay, so let's come to let's come to the workings, the cash flows. So let's have year 1, year 2, year 3. Okay. Let's come to our, how much are we selling in 1 unit?
$300.
Okay. And what is the variable cost that we are incurring?
Enough maintenance cost.
No, forget about the maintenance cost. The variable cost per carton.
It's 200.
It's 200. So what will be the contribution?
100.
Okay. So we can have our contribution, which will be 100 over here. So let's have the contribution 1, 2, 3. So we can have a contribution of 100. So in the first year, what will be the output level first year?
300,000.
Okay, so 100 times the 300,000, how much are we getting?
$30 million.
30 million. So we have the 30 million. So let's do the contribution somewhere here. Okay. So let's have our contribution. Contribution per 5-liter carton will be the 300 minus the 200. Okay, that will give us 100. So contribution for the first year, year 1, year 2, year 3. The contribution per the carton, which is 100 for every year, 100 for every year. So the demand for every year will come. Then we have the 300,000. Second year, what will be the demand? What will be the demand for the second year?
285.
Okay, 285, because this will be decreasing by 85,000 every year, 15,000 every year. So 285,000. Third year will be what?
270.
270. Okay. So let's calculate this. So this will be 30 million over here. Okay. This will be 28.5 million. Is that correct?
Yes.
28.5 million. The last one will be 27 million. Okay. So we can actually go and bring a 28.5 million here. Then we bring the 27 million here. Then we now bring the maintenance cost. Okay. There is no issue. There is no issue about taxation. So you ignore the depreciation. Okay. There is no issue about taxation. So there won't be any benefit on the capital allowance. Okay. So the maintenance cost every year is what?
300,000.
Okay. The first year is 300,000.
Yes. To increase by 50,000.
Okay, every year. So the first year will be 300,000, which is the same as 0.3 million. I hope that is correct. Would that be 0.3 million? Would that be 0.3 million? Please, can you hear me?
Yes, 0.
Okay, 0.3 million. And the second year will be 0.35 million, isn't it?
Yes, sir.
The last year will be 0.45 million. Okay. So assuming there is a tax, you just apply the tax on the net figure, but there is no issue of tax. So ignore the capital allowance. Okay. Because the capital allowance will not be a cash flow. Okay, let's come here to have our figures here. So this will give us what? I'm having 29.7. Okay. 28.5 minus 0.35. 28.15. 27 minus 0.4. 26 point.
6.
So let's count to, if we are selling in the first year, what will be the scrap value? So we are looking for all the cash flows. If we are selling in the first year, what will be the scrap value?
8 million.
Okay. So first year will be 8 million. If we are selling in the first year, that will be, the scrap value will be 8 million, which is going to be an inflow, but this is going to be decreasing if you are disposing. No, that you have to, let's come to this side. If you are we need to recalculate the maintenance cost. Okay. So let's come here. If we are disposing the machine in the in the second year, what will happen?
To decrease
To
by
be
2
5
million.
million.
Okay, but what will happen? You increase the maintenance cost for you are going to be incurring the maintenance cost for the first year, and also the maintenance cost for the what? For the second year as well before you sell. So the maintenance cost over here should be 0.3 for the first year plus the second year's own of 0.35. So if you are going to be selling at the end of the second year, it means that you are going to be using the machine for the first year, which you incur the maintenance cost for the first year. Okay. And you incur the maintenance cost for the third year as well. So, okay, the cash flow over here will be correct, but we have to bring the maintenance cost for this one. This will also be correct, but we have to bring the maintenance cost for the second year as well. Okay. The scrap value, if you are selling at the, okay, I will show the effect of the maintenance cost if I'm doing the every replacement for 2 years and that one. Okay. If we are selling in the second year, what will happen? This amount will be what? If we are selling in the second year, the 8 million will reduce to how much?
Minus.
Yeah.
Oh, okay. I thought your line had gone off.
So if we are selling in the second year, how much are we going to be receiving?
5 million.
Okay. We are going to be receiving 5 million. Okay. So we have 5 million. Third year will be what? Third year will be how much?
2.
Okay. Third year will be 2 million. So let's look at the cash flow for each year. If you are replacing in the first year, what is happening to an network? If you are replacing in the first year, what is the
This is
36 or 37?
37.7.
37.7. Second year, second year is what?
33.15.
33.15. And the third year,
28.6.
0.6. So let's come to replacing every year. Our cash flow over here will be 37. So we have 37.7. So what will be the discount factor for the first year? If we are replacing in the first year, what will be our discount factor for that? I'm having 0.9.
0.909.
Okay. So what will be our cash flow? I'm having 34.27.
27.
So what will be the NPV?
22 points. Yeah.
0.27.
20.
So replacing every year, what is we find the annual cost. This is actually a positive inflow. So we find the annual. So you look at equivalence, the analyze equivalent one. That is always going to be the NPV of the project divided by the discount factor. If it is 3 years, you use the annuity. So we have divided by the discount factor, and that will give us 22.27 divided by 0.909. Okay. What are we going to be having?
$24.50.
Okay, 24.50. Okay, let's count the replacements every 2 years. Every 2 years. Okay, so we have the years here. We have the cash flow. We have the discount factor. We have the present value. And we have the present value here. So the year 0, we have to purchase the machine at 12 million. The discount factor will be 1. Then we have 12 million. Year 1, we are not going to be disposing, isn't it? We will not
Yes.
dispose the machine in year 1. Okay. So if we are not disposing the machine in year 1, we are going to be producing in that particular year, isn't it?
Yes.
Okay. And that will be giving us a cash in.
Flow of 29.7.
Okay. That will give us 29.7. Okay. Okay. So since we are producing, there's no need for us to bring, because the maintenance cost has already been taken away from that figure. So we have our, my network seems to be unstable. Okay. So that will be giving us 29.7. So we have a cash flow of 29.7. Okay, this will be 0.909 Then if you come to the second year, what will be the cash? The cash that we are receiving, the cash flow.
Maybe 33.15, yeah.
Okay. 33, we are going to receive this one from the production together with the scrap value. So 33.15. What will be the discount factor here?
0.826.
0.826. So what are we having for them?
$7.38.
The first one having 27. Can someone confirm the 27 for me?
Okay, 27. 27.
Okay.
Yes, please.
Yeah, please. You said in this one, for the year one, we are not going to dispose the assets, so we are not getting the scrap value.
Yes, please.
But for the computation we did for year one, we used 37.7.
Because we are disposing, you get a scrap value. If you are disposing, you get the normal cash flow that you'll be getting plus the scrap value.
Oh, okay.
Okay.
Okay, so it's like when you move to each year, you consider what happens.
Yes, please. You are replacing every 2 years. So you are going to use the machine for the first year. So if you're using a machine for the
Okay.
first year,
For the
what
first
is
year.
the cost and then what is the benefit that you are going to get in? So you only realize the scrap value in the year that you are replacing.
That's sure. Thank you.
Right. So what will be our MPV for this one?
42.38.
So 42.38. So let's not count to the replacing, the equivalent amount of replacing. Okay, that will be 42.38 divided by the annual. The discount factor should be the number of shares. So that will be 0.909 plus the 0.826. So you put the two together, that will give us 0.909. If you put, I'm having
1.735.
Okay, 1.735. So what is the amount that we are going to be if you want to replace? What are we getting? I'm getting 24.43.
24.
Okay. Let's go to every 3 years.
Yes.
Okay. Every 3 years, if we are replacing, what are we going to be having? Okay, so whether you are replacing every 3 years, you still buy the assets, but just that they are not clear with the cost over there. So you just use the current cost of the machine by thinking that they are going to be buying the machine out now. Okay. So we have the cash flow here, we have the discount factor, and we have the present value. So year zero will be now, that will be 12 million. Then we have the discount factor of this. Then we have the 12 million. So we come to year one, we are going to be receiving a cash flow of 29.7. That will be 0.909 at a discount factor. Year two, what will be the cash flow that we are going to be receiving?
5.
28 point what?
28.
Okay. We are not going to be selling, so we only have the normal cash flow, 0.826. Okay. Then we come to year three. Year three, what will be the total amount that we are going to be receiving? That will be 28.6. The normal cash flow plus our scrap value. Okay. What are we getting?
0.751.
0.751. So can we get our values here? This will be 27. Okay. 28.15 multiplied by 0.826. Getting 23.25. 28.6 multiplied by 0.751. I'm getting
21.48.
21.48. Okay. So if you put all of them together, what are we getting? I'm getting 59.73. So
Yes.
equivalent of replacing will be 59.73 divided by the discount factor for the 3 years. Okay. The discount factor for the 3 years is what?
2.486.
2.486. Okay.
Answer would be 24.03.
Okay. 24.03. So looking at the equivalent NPVs, if you are replacing every year, every 2 years, which of the years are you going to be recommending to them? Because this is not cost. You can see that this is actually what? Inflow. Okay, so it's not cost that you say they should pick the lowest one. Okay, the ones that we have solved, they are actually costs. We are going to be having net cost. So if it is a cost, you will recommend the lowest option for them. But these are inflows. So which of the options are you going to be recommending for them?
They get the highest inflow every 3 years.
No. This is based if you are talking about the benefit that you are going to be getting.
Right, yes.
If you are talking about the benefit that you are going to be getting from usage, then that will be 3 years. But we want to talk about
3
how
years,
often should
yes.
we replace. Okay, if you are replacing
Every year.
first year, if you are
Every
replacing first year, the benefit per the discount factor is 24.50. So all these things are now per the discount factor. Okay, 24.50 if you're replacing every year. The benefit per the discount factor, if you're replacing every 2 years, is 24.43. The benefit per the discount factor, if you're replacing every 3 years, is 24.03. So which of them will you advise them should go for? This one is
Every year.
every year. So they should replace the machine every year. Okay. But if you are talking about the NPV that the project will be given, then they should use the machine for 3 years. But this one we are talking about replacing. So which of the years are giving you the highest outflow per the discount factor if you count to the replacement? And that is going to be this seems to be different from the one that we did in class. The one that we did in class, you are not going to be having the NPV to be inflow. It will be a negative one. So so itemize the major assumptions made in your calculation. So the first assumption is that the asset has to be purchased and used. So the current price of the asset or the cost of the asset is the 12 million, although that is not clear. Okay, everything that they are giving to us was like they have already purchased a machine and they have to give us that particular cost, but that cost was not given. So the recent increase in the cost of the processing machine, which is a 12 million, we assume that the company is going to purchase the machine outright, or they are going to purchase the machine immediately and use it for the production. So the recent cost should be the initial cost of the assets. So there will not be any tax effect. There will not be any tax effect. So the issue of capital allowance was actually ignored. Okay. the issue of capital allowance was totally ignored, and there won't be any tax benefits on our maintenance costs also, and also the cash flow. Okay, because there's no tax rate given to us over there. So we also ignore that one also. So that is about the assets replacing one. That is a question number one. There is nothing that we have to do again. Let's come to question number two, which is about the what we call capital rationing. Okay. So let's look at the required, the net present value of NPV for project C, project 6. So you can see that they have not calculated the NPV. So if you look at this place, you can see that project 6 is dashed. So we have to calculate the NPV for them ourselves. Okay. Scenario, are you there? Can you take it for us?
Let me read.
Okay.
XYZ Limited is considering such investment project with the following details. So projects 1, 2, 3, 4, 5, and 6, with their respective initial outlay and the net present value. 1. Project 6 is expected to generate the following annual cash flow, the sales and then the cost. Project 6 cash flows are exclusive of inflation at the rate of 10%. Raise additional demand. The capital for investment is currently restricted to 500 million. Project 1, 3, 5, and 6 are all independent, while project 2 and 4 are mutually exclusive. All of the above projects are divisible and none can be delayed or repeated. Required. The net present, the NPV for project 2. The optimum investment combination given the capital constraint. 2. The resulting net present value in C. Thank you.
Okay. Am I? Okay. Okay, it's supposed to be in B. Okay. So since I am the only one who didn't hear anything. Or we are all together.
We are together.
Oh,
Okay.
you didn't hear me?
Oh, don't worry. We are seeing the question. Just like it was very low, but don't worry. It is fine.
Oh, really?
Yeah, we are going to manage it like that.
Oh, yes.
Okay. So let me edit something over there. And we need to find the MPV for project 6. Okay. But they are saying that these ones are being given in what? The project cash flows are exclusive of inflation at a rate of 4% for sales income and 5% for the cost. Okay. What we have to do is that if the inflation rate will be the same, you can only find contribution and multiply them by the rate. Okay. But what we have to do is that assuming these figures are what you have to know. Okay, let me show the question itself so that I can write on it. Okay, so assuming these figures are the same, okay, if the sales should be 725 in the first year, this will increase by 1.04. So that will be the first year. Second year will be 725 multiplied by 1.04 exponent 2. Third year will be multiplied by 1.04 exponent 3. And the fourth year will be multiplied by 1.04 exponent 4. Okay, although they are different, this is how we are going to be increasing it. So the first inflation was what? 4%. So this will increase again by 4% again. So you still do it with the different figures, but it will be the 725 or the 725 for the first year multiplied by the increase. The second year the inflation will now be 2. So that will be 1.004 multiplied by 1.04 multiplied by this figure. Okay, the third year will also be the same thing. Don't do it like the first, since you are having 2 years, you're having different figures. The first year will increase by 4%. Then the second year will also increase by 4%. No, that's not how the inflation works. Okay, the inflation, the first year was 4%. So the second year too will be 4% again. So it means that the 2 years inflation will affect the second year's figure. So we need to do that one by one to get our values for that particular. Okay, so let's find the present value of that one. So let's find the cash flow of that. Let's come to the sales. Okay, so we have so let me just do the years here. So we have the years. So we have year 1, year 2, year 3, and year 4. So let's have our currency sign here. Okay, we have year 0 also here. Okay, so let's come to sales. Okay, let's go and do the workings for the sales and those ones income. Okay, so let's have the sales for workings for that one. Sales, so we have the years 1, 2, 3, 4. Okay, so we have the sales figure to be, let's bring the one by one. 725, 765, 725, 765. Can you bring the figures for me?
885.
765, 88 what? 5.
5.
And
612.
612. So the inflated, so we now multiply by the inflation. So the first one will be 1.04, 1.04 exponent 2, 1.04 exponent 3, 1.04 S.4.
754.
The first year is
754.
okay. So we have 754. Okay.
827.42.
82. Okay. 827.42. Okay. What are we going to be having for 827.42? Third year, give us what?
995.50.
Okay. Last year,
715.95.
715.95. Okay, let's go to the cost figures. What are we having for the cost?
$145.
Okay, the first one is 145.
168.
168.
202.
202.
94.
02
94.
and then 94.
So the inflation for them is what?
0.5.
1.10.
Okay.
Zero.
So we have
1.05.
1.05 S.3, 1.05 S.4. So what is going to be their respective prices?
The first one, 152.25.
152.25.
Yes.
Okay.
Year 4, 114.23.
Year 4 is 114.23. Okay.
0.23.
Yeah.
Year 3, 233.
33. 2.
233.84. 33.84.
0.84.
0.84. Yes.
Okay. 84. Year 2, give us what?
And then the second one, 185.22.
185.22.
0.22.
Okay. So let's go and send this one over here. Year 0, no. 754. Then we have 827.42. Then we have 995.3.50. Then we have 715.95. So you bring the respective cost here. So the cost for the first one will be 152.25. Second year will be 185.22. Third year will be 233.84. Then we have the 114.23.
It's 0.26.
114.26. Okay. Okay, so what are the net cash flows that we are getting? We are not going to be incurring any cost for them. So
First one,
the only two
six-
costs will be those two.
601.75.
601.
0.75.
Okay, 6. So the net cash flow 601.
0.75.
0.75.
Okay. So the second year we give us what?
642.2.
642.2. Okay, third year.
Third year is 761.16.
761.16.
761.66.
0.66 or
66.
okay. 0.84. Okay, 0.66. What about the last one?
Six zero one
601.69.
69.
Okay. So what are you
No,
going to be having
it's
here?
571.69.
The last one. 615.95
Mm,
minus 114.26. Okay, 601.69. That's what I'm having.
is it
The last one
the
is
sales? Is it
0.26.
the sales? The
It's
sales? Is it
715.95.
715? Yes. So okay.
All right. So what will happen?
Mm,
We now have the cost. How much are we purchasing the project? How much are we spending on the project? 6.
1,500.
The cost is 1,500. Okay. So let's come there and have the okay. So the cost will be 1,500. So we have dash dash dash. So let's have our cash flow now. So this will be 1,500. This will be 610.75, 642.20, 716.66, 601.69. So what is the discount factor? What is the discount factor of the company?
Senior, hold on. The year one is supposed to be 601.75.
Year one supposed to be
601.75.
601. Okay,
Yes.
so 601.
751 minus 152.
Okay, so with that one, everything is okay.
Yes.
Okay.
At least from my end, so someone can also confirm.
So the discount factor of the company is what? 10%. There is no other cost
10%, yeah.
the company has to incur. So this is how, if they are talking about capital rationing, okay, this is what they do. So we have the 10% here. So we have 1.00, we have 0.909, we have 0.826,
826.
we have 0.751,
751.
and the last one will give us what?
683.
0.683.
Yes.
So let's find our, this will be 1,500. What will be this one?
546.99.
546.99.
Five 530.46.
530.46.
0.46.
Okay.
Year 3. Year 3, 570.
Yeah.
72.
572.
01.
572. Which one? Year 2 of
Year 3. Year 3 is 572.
okay.
0.01.
572 points.
Oh,
Zero,
oh.
01.
Is 0,
006 is not 01.
Okay, the approximation should always be
Last one should be 410.95.
410.95. Okay. 410.95. Okay. So what will be the NPV?
$560.41.
5660.41.
$560.41.
Okay. So that is the NPV. Okay. So let's go to the other one that they are asking us about this particular project. Okay. So they say the optimal investment combination given the capital constraint. Okay, this is under capital rationing. Okay, if it is capital rationing and the question is saying that the projects are divisible, if they say the projects are divisible, it means that we can undertake some part of the project. So we use the profitability index. Okay, but if the question is saying that the project is not divisible, then we just pick our selection based on the what? The present values. Okay, so if the project is not divisible, it means that you can undertake parts. We just pick the values here. Okay, we just look at a combination of the various projects. So the one that is given as the highest one is 840. Okay, that is the one that is given at the highest NPV is 840. So we can undertake that project first because they say the other projects are not divisible. So the one that is given as the highest NPV are those that we are going to be selecting, looking at our what? Our cash that we have. So we pick the one with the highest NPV first, which is the 840. Then we can pick maybe 635. We can pick 540, 590. Then we count to projects. The six, we just pick it based on the available funds that we have. We pick based on the highest NPV. But if they say they are divisible, we use profitability index to select them. Okay, what do we mean by profitability index? We look at so we use the profitability index, which is calculated as the NPV over the initial investments. Okay, then you add 1 to the answer, or you can even leave the 1 because they are going to be having the same effect. But profitability index is actually calculated as the present value over the initial investment. How many times can the cash flows pay the initial investments? So we look at that. If you're having two projects, okay, how many times can your return or how many times can you recoup your cost from your return? So we measure it in that one and move one. Let's calculate the profitability index for each of the projects. So project 1, what will be their profitability index? $390 over what?
Over 5.
No, the initial investment is the investment that we are doing in each of them. Okay. So how much are we investing in project 1?
1,000.
Okay, so that will be the 1,000. So divided by 1,000, then you can add one to it, or you can ignore the one. If you ignore the one, it means that all of them will be without one. You'll still be getting the same ranking. Okay, and this will give us
0.3.
0.39.
or if you add a one. So let's just, if you want to ignore the one, there's no problem. So you just be having the 0.394, this one. So you come to project 2, their profitability index will be calculated as their NP.
325.
Okay, 325 divided by
750.
750. What are we getting? Would that be 0.5?
0.43.
0.43.
Okay, so we have 0.43. Let's come to project 3.
3.
Okay,
590.
590 divided by
1,125.
1,125. What are we having?
0.52.
0.52. Project 4.
840.
840
Divided by 1,850.
1,006 or 8.
850.
Okay, what are we having?
0.45.
0.45. Project 5.
633. 35.
Okay, divided by
1,300.
1,300. What are we getting?
0.49.
0.49. Let's come to project 6 now, which we have calculated. So project 6, we have calculated that one ourselves, isn't it?
Yes.
About 560.41
0.41.
divided by 1,500.
I think we should use the 41 and use the 560.
I'm not sure the impact will be that huge again. So the impact will not be that huge. I'm sure that will be still be the 0.37.
0.37.
Okay. So let's come to the ranking now. How much do we have available?
5 million.
Okay. Total amount available. Total amount available.
5,000.
Okay. So we have 5,000 to be the total amount available. Okay. Based on this ranking, which project should be undertaken first?
Project 3.
So if project 3 is undertaken, what is the amount that we are using for project 3? 1,250.
1,125.
Okay. So how much will be left out of the 5,000?
It's 1,125.
1,125, not 1,250.
Yeah.
Okay, so it means that that figure is supposed to be higher than that one also. So it's supposed to be 750. This will be divided by, is it going to be the 0.52?
Yes.
Okay, so that will give us the 1,125. What will be the amount that will be left out of the 5,000 after using that for?
4,875.
Okay, so let's go to which project will be the next one?
Project 5.
Okay, project 5. So project 5, how much are we putting there?
1,300.
Okay, after spending 1,300, what will be the amount that will be left out of the remaining one?
2,575.
Okay, so what is the next project that we have to undertake?
Project 4.
Okay, project 4, how much are we putting in there?
2,850.
Okay, so how much will be left after spending 1,000?
725.
Okay, we'll be left with 725. So what is the next project?
Project 2.
Okay, project 2. Project 2. How much do we need?
750.
But since they say it is divisible, it means that we can use the remaining balance to undertake that. So that will be 725.
Mm,
So you have your total to be 5,000. Okay, so this is how you are going to be. If they say the projects are divisible, then it means that you use profitability index in the ranking. But if they say they are not divisible, if they are not divisible and they are also independent, they say project 1, project. Okay, let me come. Please come here. Project 1 is what? Let's take this into consideration before we rank. Project 1,
Project 1, 3, 5, and 6 are independent.
but it means that they can be undertaken at the same time. So we have to pay attention to that now and do the ranking. Okay, we have to pay attention to that. So project 1, 3, 5, and 6, and what?
Are all independent.
Okay, but what is happening to project 2 and
But 2 and 4 are mutual exclusive.
okay, 2 and 4 are mutually exclusive. If they say the projects are mutually exclusive, means that they cannot be what? They cannot be undertaken at the same time.
The
Okay,
same thing.
so let's see whether we are undertaking project 2 and 4 at the same time. If they are
Yes.
at the same time, we have to drop 1. Okay,
So you have to drop 2.
we have to drop the what?
2.
The project 2. Okay, because the project 4 is giving us the highest one. We can undertake 2 and 4 at the same time. So since we can undertake 2 and 4 at the same time, we need to now go back to our this one and pick the ones that will come. So what are those ones that we can? So if we are not picking the 2, we need to bring project what?
1.
Okay, 1. So we can actually now bring the project 1. Okay, because project 1 is the next highest after the project 2. So project 1, how much do we need?
1,000.
But we can put the what? The 725 there. Okay, so that will give us 5,000. So you always have to pay attention to the project. If they say the projects are independent, it means that they can be undertaken at the same time. Mutually exclusive means that if you undertake one, you have to forget about the other one. They can also say the projects are dependent. If it means dependent, it means that 2 projects are dependent. So if you undertake one, you have to undertake the other, or you cannot achieve the other one without undertaking the other one. So you have to undertake the 2 at the same time. Okay, let's look at the C part there.
If someone background is making noise, won't you bring the MPV?
That is what we are coming to. That is the C part. You don't have to put everything.
Someone background is making noise.
Today you are complaining about someone's background making noise.
Hey,
Let's come to the optimal investment combination given the capital investment. So based on this question, they can ask you about what we call capital rationing. You can see that the company's capital over here is ration. They need this total amount to undertake the project. This is a total amount that they need to undertake these projects, but they don't have this amount, so their capital is rationing. Capital is rationing is a situation where we have profitable investment, but we don't have the funds to it. There's inadequate funds to undertake all the projects. You can say that all these projects are viable because they are all giving us what? A positive NPV. So we have to undertake all of them, but we don't have enough funds to what? To undertake them. So a situation where we don't have the enough funds available to undertake all the profitable projects that are available, we see that the company is the capital of the company is rationing. And this can be from 2 ways, or they can ask you the ways that a company can experience the capital rationing. We group them as the soft rationing, which is from the internal factors that the company is not willing to issue additional shares, or the company don't want to undertake the project, some of the projects, or the company don't want to raise more funds through issue of debt, or the company just want to carry out the funds using what the internal what generated funds. So it can be something that is causing the capital rationing, or causing the what the inadequate fund, but that particular thing is due to the activities of the company itself, which is the soft one. The soft rationing is within the organization, which is internal. We also have the hard one, which is external. The external might be like, okay, banks don't want to what grant additional loan facility to the entity, or there is a government legislation on borrowing and other issues. So they can ask you about the issue of the capital rationing and the soft and the hard. Soft are those factors that are internal. Hard factors are those external factors that are placing what a restriction on the what on the capital that we have. So let's come to the resultant NPV. So we have the project 1 or project 3. Okay, so what is the NPV for project 3? We are undertaking the project 3 in full. What is the NPV? So we bring it here. Project 5, we are undertaking it in full. Project 4, we are undertaking it also in full. Project 1, we are undertaking it partially. So what is the NPV for project 3? That will be 590. Project 5 is 635. Okay. Project 4 is 840. Okay, project 1. How do we get a project 1 now? How much are we using to get the 390? How much are we using to get a 390?
$1,000.
Okay, so but what is the portion? What is the portion of the investment that we are undertaking? We are using only 725. So if 1,000 is giving us 390, how much will 725 give to us?
$282.75.
So 725 divided by 1,000 multiplied by 390. So 28.
2.75.
Okay. 282.75. So you put all of them together, that will give you the resultant what?
Linus, the last one, do you mean
Hello,
project 2?
hello, sir.
Yes, please.
The project 1, is it 775 or 725?
The amount that we are using.
Yes.
No,
which you have been
okay.
used.
Oh, let's check that again. 1125 plus 1,300 minus 1850. Okay, let me take that again. 1125 plus 1,300 plus 1,800 minus 5,000 is 775. Sorry.
Yes. Yeah.
Okay. 775. So this is supposed to be 775. So if it is 775, how much are we getting there?
$302.25.
Okay, 302.25. Okay. Yeah, Senior Mike, you are saying something.
Yeah, I got up a bit, so let me take you back. I don't understand why we gave it to project 1. I mean, total amount available, rationing the capital.
They say project 2 and 4 are mutually exclusive.
Okay.
They
Okay.
cannot be undertaken at the same time.
Okay, so it means when you're undertaking, you have to take them at the same time.
The project, no, project
2 and 4.
2 and 4 are mutually exclusive. It means that you cannot undertake the two at the same time.
Okay.
Senior Linus,
Yes, please.
it's 725, not 775.
Or how?
It's 725, it's not 775.
1125 plus 1300 plus 1850 minus 5000. 725. Hey, assembly.
So it's still the 82,
Okay, senior, add again. Add again. Because I don't know how come I also got a
282.75.
282.75.
0.75. We can make it 283 because the other numbers are whole numbers, right?
No, please. The figures are in thousand. So add all of them, 590 plus 635. So how did I get the 775? 1125 plus 1000.
The project first one is 50. If you don't add the 50, you are going to get the 775.
1850 minus
18. Yeah, but it's still the same.
Okay, 7725. 725.
Yes.
Okay.
725, yeah.
Okay. So 725. So you just put your MPV for each of them together. That is a resultant MPV. Okay, that is a resultant MPV.
2347.75.
Okay, 2347.75.
47.75.
Okay, please. The capital rationing, they have examined the theory part where they ask about capital rationing. And, but just that they are here to, if they want to do the capital rationing, this is how it will be examined, and the factor will always be the factor will always be the MPV. So you just have to pay attention to okay. So that is about the issue of capital rationing. Okay, let's pick issue about sensitivity analysis, which they are here to examine under the FM. We look at the asset replacement, the leasing, or that one. So we have done the replacement already. We have done the capital rationing. We are coming to do the sensitivity analysis, then the lease or buy. Those are the advanced ones. Okay, so if you have time, we can look at the question number 5 to do everything now on the MPV. So question number 3.
Question number 3.
Yeah.
Alcohol limited. Okay, so let me read the required. Required. Determine whether the project is viable or not using the next MPV method. B. Calculate the percentage by which the following conditions.
Madam, it's like you're far from your device.
She's far from where?
Please, can you hear me now?
Yes, please.
So I'm reading the required first.
Okay.
A. Determine whether the project is viable or not using the MPV method. B. Calculate the percentage by which the following condition factors of ARCO must change in order for MPV to be zero. Selling price, variable cost, sales volume, initial investment, useful and cost of capital. Now the question. ARCO Limited is planning to invest 5 million in 8 sound engineering studio with a lifespan of 10 years. ARCO charges 5.5 cedis for every compact desk. Plans to produce 8,700,000 cedis each year. ARCO evaluates all investment opportunities against a discount factor of 21%. Required. A. Determine whether the project is viable or not using the NPV method. B. Calculate the percentage by which the following condition factors of Apple must change in order for NPV to be zero. Selling price, variable cost, sales volume, initial investment, useful cost of capital. Thank you.
Okay. Okay, so this is sensitivity analysis. So what normally happens is that we estimate the cash flows thinking that it is going to be like that for every year. But what if something happened? So what would be the percentage change in any of the variables that will make the project to break even? And they are asking us by these variables. So we'll be looking at them one by one, although we have solved questions like this before. So they are asking us to calculate the what? The NPV. If you are doing sensitivity analysis, the focus is not about computation of the NPV. So they will not give you too much information on the NPV. You can see that they have given a very simple information on the NPV. How much are we charging per cassette? How much are we charging per compact disc?
5.5.
Okay, and what is the cost that we are incurring to do that?
4.8.
Okay, so what will be the contribution from there?
0.7.
Okay, so you can just find your, so we have question number 3, which will be the ACO Limited. So let's have the cash flows here. So this one, we'll just do it very simple. You don't have to. So we have the years here. We have the cash flow. We have the discount factor. Then we have the present value. So how much are we purchasing? How much are we purchasing there?
Let's count 500, so that will be 5,000.
How much are we, but how much are we paying for it?
You're trying to invest 5 million.
Okay.
That,
So that will be, the initial outlay will be 5 million, 1.00. Then we have 5 million. Let's go and calculate the cash flows. So the cash flows, let's calculate let's do workings over here for the cash flow. So the annual cash flow will be what? Will be 5.5 minus 4.8 multiplied by what? The number of units that we are selling. How many units are we selling?
8,700,000.
So we are selling 8,700,000 every year. So this is going, the costs are going to be the same every year. So you can have a constant annual cash flow by making it now to be annuity. So we have 8,700,000. How much are we getting?
6.09.
Okay. So we are having the annual cash flow be 6.09. So how many years are we going to be undertaking these projects?
10 years.
So you just have 1 to 10, 6.09 as annuity. What is the discount factor?
21%.
21%. So annuity, 10 years for 21%. How much are we getting?
$4.675.
4 points.
675.
Okay. 4.675. How much are we getting?
$28.47.
28.47.
So,
So
yeah, the annuity is 10 years, right?
yes, 10 years.
I know, maybe let's get another, because I got 4.054.
The
Yes, I also have same. That's one. Yes, it's
4.054.
4.05.
4 points. Okay, it's 4.054. So
05.
the people mentioned the 4.054 are more than. So it's 4.054. What are we having?
Yes, okay, yes.
You will not have anyone to confirm this for you. So you always have to be very careful when you are calculating this. But you are going to be
24.69.
an table, so no problem. 24.69.
This nine.
Okay. So how much are we going to be getting as the NPV?
19.69.
Okay. So should the project be undertaken?
Yes.
Yes. Okay. So this is just the NPV side of this. Okay. So we come to
The seven sensitivity analysis.
the sensitivity analysis. Calculate the percentage by which the following conditioning factors of ACO must change in order of the NPV to be zero. So whenever they are asking you that you should calculate the percentage change of certain variables, they are just asking you to do the sensitivity analysis of that. And we said that the last time that what we do is that for this one, okay, if you count to the selling price is just the sales. So the sales will be 5 points for the 10 years. We do it for the 10 years because the project is 10 years. So currently, this is 5.5 multiplied by 8.7. How much are we getting?
47.85.
Okay, 47.85. So currently we are generating a revenue of 47.85. That is giving us an NPV of 19.69. Okay, 19.69. What we are trying to do is that, okay, what is the percentage of the sales that is giving us the NPV of 19.65, 19.69? What is the percentage of the sales that is giving us that particular NPV? What is
41%.
Okay, 41%. Okay.
21.15.
Okay, 41%. So currently, our net present value is 41% of the sales revenue. What it means is that if our sales revenue falls by 41.14%, we are not going to be getting this again. If the sales revenue should reduce by this, you can check it and see. Reduce the sales revenue by this figure, or reduce the selling price by the 41 point that, and see whether you are not going to be getting the same answer as the cost. So 41.14 minus 100 divided by 100 multiplied by 5.5.
Yes.
Okay. $19.69. 19.69. So we have so 5.5 multiplied by 8.7. So 19. Okay, sorry. We should find the present value of the
present value
of the selling price. Okay. So it is always be the present value. So we need to find, we don't need to use the full amount. So we find the present value. Sorry about that. Okay. So let me just take you there. It should always be the present value. So let's come to the sensitivity analysis, which will be the B side. So sensitivity analysis is calculated as the NPV over the present value of the variables. Okay, multiplied by 100. This is only for the cost. Okay, this is only for the cost. Okay, okay. So someone is saying that we should. Okay, So let's use the, okay, let's check that using the initial investment and see. So what is the initial investment? The
5
initial
million.
investment is 5 million. Okay. So currently, what will be the percentage of that? That will be 19.69 divided by 5 million multiplied by 100. Okay. So what percentage are you getting?
3.94.
Okay, which is the same as 393.8%, isn't it? Okay. Increase your initial investment by that amount and see what they are going to be getting. So increase your initial investment by the 3.3. You'll be getting 19.69, isn't it? Okay, so if our investment, the initial investment increased by this amount, the project will be break even. You can try that. You can decide to add the plus 19.69 over here. You see that this project this one also be 24.69, and the project will break even. So that's what we are trying to do for that. Okay, what change in the cost or in the revenue that is going to be giving us what? A zero what? NPV. Okay, so we are doing this for the selling price first. We are doing this for the selling price first. For the selling price, we have the NPV of the project itself divided by the present value of the what? The
The selling
variable.
price.
Okay, so the selling price every year is 5.5 multiplied by 8.7. Is that correct?
Yeah.
Okay, so we are getting 47 what?
47.85.
47.85. So that is every year. So we present value that by using the annuity factor for 10 years. Okay, then you multiply your answer by 100. Or we can also do working somewhere for that. So let's come to the workings for the selling price. So the present value of the selling price will be the 5.5 multiplied by the number of units that we are selling, which is 8.7. Then this is every year, but we are going to be selling this for 10 years. So we find the present value using the annuity factor. What are we having?
193.98.
Okay, 193.98. Okay, so let's come here. We have 19.69 divided by 193 point what? 98.
9.
Okay, multiply by 100. What are we having?
10.15.
10 points.
15.
Okay, so we have 10.15%. Okay. So reduce your selling price by this percentage and see what you are going to be getting. Okay. So if you reduce, you'll be getting 4.9 something, isn't it? If you reduce your selling price by, it's because of the approximation. It's supposed to give you the same value as what? As the cost. Okay. It will give you the same value as the cost because of the approximation. You'll be getting 4.880, but because of the approximation, that's why we are having the 4.1. Okay. The 4.90. Let's go to the other one. They can sometimes ask you to interpret this. It means that if the selling price falls below what? Or
Below 10 points.
if the selling price falls by, if the selling price falls by 10.15%, the project will what?
Will equate to 0.
Okay, will break even. The project will break even. But if it will fall beyond 10.5, the project will what? Will run into a
A
loss.
loss.
Okay, so let's come to the next one. The next one, what are we going to be having there?
Variable cost.
The variable cost is just the associated cost given to you. So we have the variable cost, which will be the next one. That will also be calculated as the NPV over the present value of the variable cost
Variable cost.
multiplied by 100. So let's go and do the variable cost. Okay. So we find the present value of the variable cost. That will be 4.8 multiplied by 8.7 multiplied by 4.054. Is that correct?
Yes, yes.
Okay. How much are we getting?
$169.2.3.
So 169.30.
30.
Okay. So let's come to our sensitivity of the variable cost. We have 19.69 divided by 169.30 multiplied by 100%. What are we having? 11.63%. Is that correct?
11.63%, yes.
Okay. Increase your variable cost by 11.63 and say something. You are getting something closer to 5.58 something, isn't it? If you increase your variable cost by the 11 point something, you'll be getting 5.58. Is that correct?
No.
You are getting 5.58 if you increase. If you increase and you add, if you increase, it will be the new variable cost of 4.8 plus the increment. So the total will give you 5.5 something. Are you getting that figure?
No.
Okay, it's supposed to be a 5.5, supposed to be 5.5 as a selling price, but because of the approximation, that is why we are having the
5.38358. Yeah.
okay. It's supposed to give you 5.5. It's supposed to give you the same value like the selling price, so that you it's supposed to give you something closer to that, so that if you subtract, you're supposed not to be the selling price. Okay, so 5.38. So that if you subtract the selling price from it, the contribution will just cover the initial investment. It's supposed not to be exactly as the selling price. It will give you the same as the contribution. It will give you the difference as the contribution, and the contribution will be equal to the initial investment of 5 million, and the project will be break even. So this is about cost. If the variable cost increased by 11.63%, the project will break even. So let's look at what they are.
Sales volume.
They are talking about sales volume, isn't it?
Yes.
The sales volume, we see that the sales volume is the same as what?
The
Is it?
the production.
Contribution.
Okay, the sales volume is the same as the contribution. So we have the present value of the contribution. Okay, we have already calculated that. Okay, the figure over here is the contribution, because you can see that the 5.50 minus 4.80 is the contribution here. So we present value the contribution. So that would be the
6.09.
okay. So we have 19.69 divided by 24.69 multiplied by 100. What are we getting? Hey, 79.75%. Okay, what is the meaning of this? What is the interpretation of this? This is contribution. This is like revenue.
Means when revenue falls by 79.75, the NPV will be 0.
Okay, so you can also try that by reducing your 24.69 by the percentage there. Okay, if you reduce by that particular percent, we are going to be having 19.69, isn't it? Are you having 19.69? If you reduce by that figure, the reduction will be 19.69, and the new contribution will now be only 20.25%. So our contribution will now be 2.25%. If it is falling by the 79, the remaining contribution will now be 2.25%. So you can 0.25%. You can multiply it by the current contribution now, and you'll be getting something like 4.999. Okay, so if the contribution reduces by 79.75%, the figure that will be left now will be 4.99, which will cover the initial cost. Okay, so that is it. Let's come to the initial investments. Okay, the initial investments. Okay, the initial investment will be the NPV divided by the present value of the initial investment, which will still be the same as the initial investments. Because the initial investment is the amount that we are incurring now. So the present value is the same as that particular value. So that will be 19.69 divided by 5 multiplied by 100. That will give us 368.17%.
$393.86.
393, okay. 19.69 divided by 5 multiplied by 100. Okay, 393.8%. So if our initial investment increases by 393.8%, our project will break even. If you are calculating for revenue item, the figure will be a reduction. But if it is a cost item, it will be an increase. Okay, let's come to the next one. Okay, let's come to the next item as well. Useful life. Okay, it's supposed to be useful life. So if we want to do this one, the useful life, what do we do? What do we calculate for if we want to do it for the useful life? What are we going to be doing? We calculate a discounted payback period, isn't it? Okay, we calculate a discounted payback period. So we calculate a discounted payback period. Okay, so this project will pay. This project will pay within what? Within some months, isn't it? This project will pay back within some months. This project will pay back within what? Some months. Okay. So what we do is we use discounted what? The discounted amounts. So we use a discounted amounts. Okay. So this will not be applicable over here, but I just put it there to show. So what we do is that let's have the years here. Let's have the years. We have the cash flow. Then we have the accumulated balance. So we have year 0, our cash flow will be 5 million. We still have 5 million. Year 1, what is our present value of the cash flow? Year 1. What will be the present value of the cash flow year 1? Present value of the cash flow year 1. Can we do it one by one?
Yes.
Okay. So we have 6.09 multiplied by what?
Year
will
one
be-
is 5.03.
Okay. 0.03. So this multiplied by 0.826. Okay. So multiply that one, 8 point this one multiplied by 6.09. Are you sure? I'm getting
5.03.
5.03. Okay. So year 1 will be the cash flow will be the discounted one. The annual cash flow is 0.09. That is the annual cash flow. So you discount it using the present value for the first year. But the one that we have calculated over there is annuity. So 1 divided by 1.21. I'm getting 0.826. So if you multiply that, you'll be getting 5.03. Okay, 5.03. Okay, so it means, can we make it just 5.0 so that we know that the project will break even in the first year? Okay, so this will give us 0.
Yeah.
So the discounted
So
payback period is 1 year. Okay, but what is the useful life of the
10 years.
10 years? So calculating the change in the useful life, you just have your useful life. Okay, depending on the one that is higher, minus the discounted payback period. So you just have to look at whether it is going to be increase or it's going to be a reduction. Okay, whether it is going to be an increase or it's going to be a reduction. If the payback period is going to be higher, then it means that if the useful life should increase by that particular percentage, it is going to be break even. But if it is discounted payback is lower, then it means that if the useful life reduces by a certain percentage, that will give you, so we have the useful life over here. Okay, so we have 10 years minus 1 divided by 10 years. That will give us 9/10. Okay, so we have 9/10 multiplied by 100. That will give us 90%, isn't it? Is that 90%? Okay. So if the useful life of the project reduces by 90%, which if it reduces by 90%, the project will break even. How do you mean by the project will break even? The useful life now is 10 years. So if this will reduce by 9 years, the project will break even, as we have seen in this particular illustration over here. Let's go to the one on cost of what? Capital. So the one on cost of capital. If you want to find the cost of capital, we are just looking for the percentage increase in the cost of capital that will give us the internal rate of return. So we have the internal rate of return minus the existing cost of capital, cost of divided by the existing cost of capital. Cost of what? Capital. Multiplied by 100. So mostly they will examine you. If they want to examine you, it will be on the variables. Okay, so we need to find the internal rate of return here. We have the first one already. 21% is giving us 19.69. So what rate will give us that one? So we have to increase the rate, let's say 40 or 45. You can try that because we have tried a question in class on this one. Let's do
35 will give us negative.
35 will give us negative. Okay, so if
Yes.
we're using 35, what are we getting? Let's try that. So if we can get an exact one. So 35, we have the years here. We have the years, we have the cash flow. So if we are using 35, we have cash flow, we have the discount factor of 35%. Then we have the present value. We have the year 0, that is 5 million. Then we have 1.00. Then we have the 5 million. We have 1 to 10, that will give us 6.09. What will be the annuity for? 35% for 10 years.
2.715.
2.715. So if you multiply, what are we getting? Are you sure the 35 will give us negative?
Yes.
I'm getting the present value to be 16. We are going to do it for 10 years, so not only a year. So if you do 35 for a year, that's why you are getting more. Okay. So that will not give us. So maybe you can increase it to maybe 60 and see. But that is not applicable. For this question, the cost of capital as a factor is not added. So I just added it to show how you can calculate it. It is pulling the first four. The useful life is not part. The cost of capital is also not part. But I just added those ones for
So we can reduce our cost of capital.
okay. They are not part. I just added this one to just demonstrate how we do those ones. Let's come to question number 4, which is about the lease or buy.
Question 4.
Yeah.
Can you hear me?
Yes, I can hear you.
Question 4 required. A. Advise A. Required. Advise Kobe Limited on whether it should lease or borrow to finance the new vehicle. B. Examine three reasons other than possible after tax cost advantages why Kobe Limited may choose to lease rather than buy the new delivery vehicle. Kobe Limited is about to replace its existing delivery vehicle with a new design of a vehicle that offers greater fuel economy. The company will save running cost of 200,000 per year. There are two financing options available. Option 1, borrowing funds and purchasing the vehicle. The vehicle could be purchased for 3,400,3.4 cedis using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years and would have a residual value of 1.4 million at the end of that period. Straight line tax allowable depreciation. Straight line tax allowable depreciation is available on the vehicle. The vehicle will be to a special tax of 60,000 at the end of each year of operation. The tax expenses are corporation tax deductible. Option 2, leasing the vehicle. The vehicle could be leased for a period of 4 years for a payment of 600,000 per year, payable at the start of each year. The lessor will pay the special tax. Lease payments. Lease payments are corporation tax deductible expense. The firm after tax weighted average cost of capital. The firm after tax weighted average cost of capital is 8%. The company pays corporation tax at a rate of 30% 1 year in arrears. Required. Advise Kobe Limited on whether it should lease or borrow to finance the new vehicle. B. Examine three reasons other than possible after-tax cost advantages why Kobe Limited may choose to lease rather than buy the new delivery vehicle. Thank you.
All right, you're welcome. Okay. Okay, so this is about buying or what, or leasing. What did we say about buying? What do we say about buying and then leasing? What discount factor do we use?
Freight tax.
Uh,
Hey,
what tax rate do we use? I've said this one. Oh, don't go there. You are giving two rates now. Okay, you are giving two rates now. So which one are you going to be using? You don't know. Then you just be there. You'll be, because you didn't listen. You just be there. Okay. I said that if you are coming to lease or buy, we assume that the company is going to be financing the purchasing option by borrowing funds from a bank. So the discount rate will always be the after tax cost of borrowing. So the 8% given to you over here, please ignore. The firm after tax weighted average cost of capital is 8%. The purchasing will always be assumed to be financed through borrowing. So you can see the option one, borrowing funds and purchasing the vehicle. So it will always be you are borrowing funds to purchase the vehicle. So if you are now purchasing the vehicle, what is the cost that you are going to be incurring? So we look at the leasing will always be assumed to be operating lease. Okay, but if it is a finance lease, then it means that you are going to be charging depreciation on the right of use. So you'll be enjoying tax benefit on the capital allowance too, which is a depreciation. So let's come here. We have the purchasing option. So let's have the purchasing option. Okay. So the purchasing option, the machine will take how many years? What is the useful life of the machine? Are we giving that?
4 years.
It's 4 years. What?
Yeah.
Okay, 4 years.
4 years.
Okay, that will be 4 years. Okay. Okay. So 4 years we're going to be having the years here. Then we have year 0, year 1, year 0, we have 1, we have 2, we have 3, and we have 4. So we have the initial cost. How much are we buying the machine?
3.4.
Okay, we are buying this at 3.4. Okay. We are buying this at 3,400. The year one will be dash. Okay. Is there any benefit that will come as a result of replacing? You consider the 200,000.
It's saving running cost.
So we are going to be saving what? A running cost of 200,000, isn't it? Okay. What you have to know is that the running cost that you are saving, the savings will be for both sides. So you can ignore that one. Okay. If you are leasing, you are still going to be saving the 200,000. If you are buying to, you are still going to be saving the 200,000. So the 200,000 will be having the same effect. The 200,000 will be having the same effect. So you can decide to ignore that. But if you don't want to ignore that, then you can bring the cash flow. So let me show that. Assuming the savings, they can give you a question that the savings will be for only one. So you can bring our cash flow here, which will be the running cost. So
But the saving is for placing the existing vehicle.
if you are replacing, you can still lease. You can replace the existing vehicle by leasing. You can lease it and use it. You are still replacing. The replacing is not actually by you buying or so the company estimate that the replacing the existing will save running cost of what? 20,000 per year. So it means that we have a vehicle now that we are using. Okay. But we don't want to use it again. So if you don't want to use it again, we can buy a new one to replace it, or we can go and lease to use it. So if you are leasing, the leasing will still reduce your running cost. If the leasing will not reduce your running cost, you will not even go for the leasing in the first place. So the running cost is for both the leasing and also the purchasing option. We are just going to be stop using the existing vehicle. How do we stop that? We can go and buy, or we can go and lease a new machinery that will be saving the cost. So the 20,000 is actually for the two, but I will show it, although it's going to be having the same impact, but I'll show it in case it is going to be on only one. So we come to the core savings. That will not be an actual factor there, but let me just show this one, the core savings. Okay, the core savings will be, so let's have the core savings. Okay, so the core savings will be year one dash. So we have 200 here, 200 here, 200 here, 200 here. Is that correct? Okay. So we have 200, 200 for 200. Let's go to the capital allowance. So this one, this core savings now will be tax deductible. So we can charge tax on that particular cost. So this will be tax deductible. Will be, if this was tax deductible, so you now saving this cost means that you have to pay tax on the cash flow. What is the tax that we are paying? What is the tax rate?
30%.
30%. So 30% on that will give us what?
$60.
Okay, so 60, 60, 60, and 60. Okay. We are going to, let's say the company will be paying a special tax. So special tax is how much?
60.
Okay. The special tax is, what is the amount for the special tax?
60.
Okay, that will be 60. So, oh, okay, the special tax is just a coincidence that is the same as the tax that we are paying on that one. So you can, I said that you can actually ignore the core savings because it will be the same for the two, but let's just show it. So we have the special tax of 60. That will still be a 60. That will still be a 60. That will be a 60. Let's go to the tax benefits on our tax benefit on the capital allowance. So let's go here and have the tax benefit on the capital allowance. Okay. So they say the straight line tax allowable depreciation is available on the vehicle. Okay. So we are going to be looking at how do we calculate the tax benefits. So we are going to be using how the company will be charging this one now, how the tax authority will be doing this. Okay. What we have to do is that you can do the tax computation like how the company will also be doing their tax depreciation. So let's come here. Let's have the tax benefits for the entity. Let's do it the way the tax authority will be doing it. So we have the years here, we have the cost, we have the depreciation, then we have the tax benefits. Okay, year one, what is the cost of the asset? 3.4, isn't it? The depreciation will be how much? 3,400 divided by 4. I'm getting 850, isn't it?
Yes.
And the tax benefit on the 850 will be 30%. So we are not going to be paying tax of 30% on this amount. I'm getting 255.
255.
What will be the carrying value in the okay.
2550.
Okay, they are not using straight line, they are not using reducing balance basis, but you have to be showing this for the purpose of the last year capital allowance. So you have year 3,
Yes.
that will be minus 850. I'm having 1,700. I'm having 850 here, and this will still be 255. In the last year, what's supposed to be the balance? 850, isn't it?
Yes.
Okay, but what is the residual value of the assets?
1,004.
So it means that we are going to be getting a gain. The carrying value of the asset at that time will be 850. But if you sell it for 1,004, you are going to be getting a gain of how much?
$2,000. Hey,
Is it
Five.
550?
oh no.
We get a gain of 550, isn't it?
Yes.
We get a gain of 550, isn't it?
Yes.
Okay, so you pay tax on the gain now. What will be the tax that you pay on that particular gain?
165.
165.
So you will now go with the tax benefits. The tax benefit for the first year. They are not giving us how the tax will be paid. So we are going to be having 255 as a benefit, 255 as a benefit, 255 as a benefit, and the last year will be 165.
The tax is pay 1 year in arrears.
Is that what they are saying?
Yes.
Hey.
Are you sure?
They said the firm after tax
Yes.
weighted average
Yes.
cost of affairs
The last
8%. The company pays
Okay.
corporation tax at a rate of 30%, 1 year in arrears.
Okay. So this
But
benefits.
Sinalano,
Yes, please.
when you are using straight line method for depreciation, where we normally reduce
No, the tax
deduct.
benefit will be given to you based on how you are paying the taxes. So all this, the tax, it will be 60/60. So all the issues about the tax will be in in the next year. So the company will be paying a special tax. So I have to clean everything there and now do a new one for the, okay.
Sinalano,
Yes, please.
I was asking about the depreciation. But if it is a straight line, we are supposed to deduct the scrap value before we apply the depreciation, right?
You'll be getting the same answer as the final one. Okay. So if you calculate that and put your total tax together for the 4 years, you'll be the same as the 255 plus 255 plus 255 minus what? 165. You can try that and see 3,400 minus 1,400 multiplied by 0.3. I'm getting 600. So you can confirm that and see 255 multiplied by 2, 255 multiplied by 3 minus 165. You'll be getting 600 as, but this one I'm doing it on the way the tax authority will be doing it. The way you are doing it is the company, that is how the company will calculate it. The tax authority will not take your residual value into consideration until the asset has been sold. Okay, so this is for the tax authority. I have to show everything now for this one again. So I have to take this one off. Okay. So let me bring my workings for the depreciation here, and let me bring my workings for the depreciation here. So I can go to the next board and have that particular one. So we have the workings. So we have the years, we have the cost, we have the depreciation, and we have the tax benefit of 30%. So Let's come to year one. We have 3,400. We have 850. Tax benefit of 255. Tax benefit of 255. Two, we have 2550. We still have the 850. Tax benefit of 255. Three, we have 1,700. We are having a depreciation of 850. This will still be 255. Then we now have 4, which will now be 550 as a gain. Then we pay a tax of 165. So in all, you'll be having a tax benefit of 600. So let me just come and take this one off and now show the purchasing option over here, because we are going to be having year 5. Okay, so let's come to the purchasing option here. Okay, I'll have the years here: 0, 1, 2, 3, 4, 5. So let's keep 3 zeros at the top. Okay. So let's come to the initial cost. Initial cost is 3,400, isn't it?
Yes.
Okay, we have the dash there, dash there. We have the cost savings, which is a maintenance cost. We have dash. This will be 200. This will be 200. This will be 200. This will be 200, and this will be 200. Okay. Please, can we put the task together? The task figures, can we put them together? Okay, we are going to be paying tax of 30% on the cost savings. Okay, it will not be, it will be dashed for the 5th year because the machine is having a useful life of 4 years. So we'll be paying tax on this figure by 30%. Okay, how much are we getting? We'll be getting 60 every year, isn't it? Okay, that 60, we are going to be paying tax of what? A special tax of 60 every year also. That will give us a total of what? That will give us a total of what?
120.
Okay, but let me just show it one by one so that you, or let me go and calculate the tax. Let's calculate the tax expense and the tax benefits also together. Let's come here. The tax expenses are cooperation tax or deductible. The tax that we are paying, the special tax, they are cooperative or they are cooperation tax deductible. It means that they will be allowable for tax purposes also. So we'll still be getting tax benefits on the tax that we are paying. So let's come to the total benefit that we are going to be getting over here. So we have tax benefit for depreciation, which is going to be, so let me come here and do the workings for the tax benefit and then the total tax. So let's come to the tax expense here. Tax expense. So the years over here. Okay, so let's have the years here. Year 1, 2, 3, and 4. So let's have 1, 2, 3, and 4. So let's have the currency sign here.
We don't want to be twice.
Is that?
People 1 year in arrears.
No, if we are saying, if you are sending it there, then we use the 1 year in arrears or 1 year in
Okay.
arrears. So the tax on the cost savings. So maintenance cost tax, maintenance cost tax. That will be 60, isn't it?
Yes.
Okay. So we also have the special tax. That will also be 60, isn't it?
Yes.
Okay. The capital gain tax. The capital gain tax will be the tax that we are going to be paying when the asset has been sold. In the last year, that will be 165. So let's find the total tax for each of them. That will be 120. This will be 120. This will be 120. And this will be what? 285.
285.
Okay. Let's come to the tax benefit also so that we know that we are going to be having a complete information so that we just send it there. Okay, so let's come to our tax benefit. We'll be getting tax benefit on the capital allowance every year, and we also be getting the tax benefit on the special tax that we are paying. You see, it is tax deductible. It means that they will give you tax allowance on that. So let's have the years also, year 1, 2, 3, 4. So you come to capital allowance. Okay, that will be 255, 255, 255. And the last year dash because we are paying tax. So we come to special tax. Okay, the special tax, we are paying 60. So they are going to give us a tax allowance of 30 on that. So it's 30 multiplied by that. I'm having 18 here, 18 here, 18 here, and 18 here. So what are we having? 18 for the last year. And having 273,
273.
273, and 273. Okay, so let's go to our tax expense there. So this will be paid in first year, will be paid in second year. So we have 120. So we have 120. We have the 120. Then we now have this. We now have 285 here. Okay.
Atinyalano,
Yes, please.
the 18, there is already a tax. So
Yes,
how are
say
you
it is
getting
the tax expense is tax corporation tax deductible. So if you pay the tax, they will still allow you to subtract that tax. So the tax expenses are corporation tax deductible. So if you pay the tax, they will allow you to subtract that tax that you have paid from your profit before the tax authority will charge tax on the remaining amount or the remaining profit. So it is allowable to be taken from your profit before tax will be charged. That is why they are saying it is tax deductible. So you enjoy tax benefits on the tax that you have paid, which will be a 30% on that particular amount. Okay. Let's come to the tax benefits. The tax benefits will be, we have a tax benefit will also be claimed in the manner that the tax is being paid. So 273, the tax benefit will be addition. So 273, 273, 273, and 18. Let's find our cash flow now. 3,400. We have 200. What are we going to be having here?
73? No. 400.
I'm having 253 minus 18. This will give
Yes,
us 260.
253.
Okay. What is our discount factor?
I use the weighted.
What is our discount factor? What rate are we using?
The 4%.
Okay. We use the borrowing rate, which is going to be after tax. So we have 4%. So we have 1.00 4% discount factor in the first year. What are we having? $0.962. Second year is what?
$1.886.
Second year?
1.886.
No, that it means that you are doing annuity. Second will be one divided
0.925.
925.
0.925.
0.925. Third year is what?
0.915.
Third year?
0.889.
0.889.
No.
Okay, fourth year?
0.855.
855.
855.
855. Okay. Last year, the fifth year?
0.822.
0.822. So let's find our 3,400 as a cost. Let us find our cash flow one by one. 2 multiplied by 0.962. I'm having 192.4. So we have the 0.925 multiplied by 353. I'm having 326.53. 0.889 multiplied by 353. I'm having
313.82.
okay. Let's go to the fourth year. 353 multiplied by
301.82.
301.82.
301.82.
Okay, so we have 267 multiplied by 0.822. I'm having
Negative 219.47.
So what will be the net cost under the list, the purchase option? The net cost is what? So you just add
Unless you go back to the notes.
okay. So let's try that. I'm having 2484.9. Okay.
Negative 2484.9.
Okay. So let's come to the leasing option. So if you want to lease, if you want to lease, you are not going to be buying, so there will not be any initial cost, and there will not be any capital allowance also, because the lease is always assumed to be operating lease. Okay. So we have the years, we have the year 0 here, year 1, year 2. Okay, let's look at how they are paying the lease rentals. So maybe year 0 might not be appropriate. Okay.
600 year at the start.
Okay, so year 0 will be appropriate there. So
Yes.
they are paying in advance. So they will pay now. That will be the year 0. So 3, 4, and 5. So let's come to the rental payments. The rental payments. So let's come to the rental.
Can you tell me it for the year 1 to 5?
So the rental payments is rental payments. Rental payments. We are paying in advance. So the first one will be paid now. How much are we paying? So we are going to pay
600.
1 now. So that will be 600 every year for 4 years, isn't it?
Yes.
Okay. So we have, so we pay 1 now. This will be dash. This will be dash. Okay. This will also be giving us cost savings. Okay. So the cost savings will still be 200, 200, 200. The running cost savings 200, and we are going to be paying tax on that one too. But let's see if we are going to be having other tax benefits there. Okay. Okay. So let's come here. The vehicle could be leased for a special period of for a period of 4 years for payment of this one at the start of the year. The lessor will pay the special tax. The lessor will pay what?
The special tax.
So it means that the
So it's
special
not.
tax is not going to be a cost over here for us. Are you okay?
Yes.
Okay. The lease payments are cooperation tax deductible. So for the lease, what you are going to be seeing is that is only the tax benefits of the amount that you are paying. So let's come to the tax expense that we are going to be making on this amount. So every year we'll be paying 60. So we'll be paying 60. We'll be paying 60 on the cost savings, 60. Okay. Let's come to the tax benefits on the, so there will not be any tax benefit as to residual value because the asset is not our own, it's an operating lease. Okay. But if it is a finance lease, then you will be getting capital allowance on the rental payment, which is principal together with the interest, but you also get capital allowance on the depreciation of the right of use. But the lease will always be operating lease. So we are paying a rentals of 600, and this will be allowable for tax purposes. So it means that we are not paying a tax of 30% on this amount. What will be the tax benefit every year?
180.
Okay. So we are going to be enjoying tax benefit of 180 every year, but this will be enjoyed in the manner in which the tax is being paid. So we have 600 here, we have 400 here. What are we going to be having from this place? We are going to be having 120 here. So we have 200 plus 180 minus 660. I'm having 320 as positive here. Okay. So we have 600 minus 200 plus 60 minus 180. I'm having 280, negative 280 here.
Yes.
Okay, this place will also be negative 280.
80.
Okay, so can we find the present value for them using the same thing, 4%? We're going to have 1.00. So let's bring that one here. We have 0.962.
Hello, sir.
Yes, please.
So the tax benefit of 180, right? The 180, the tax benefit of 180.
Yeah.
I'm asking where did we get it from?
It is the tax benefit on the rental that we are paying, 30% on the 600.
Oh, okay.
Yeah. So we have the 0.889 here. Then we have the 0.855. Then we have 0.822. So can we do that multiplication and
Hello, sir.
yes, please.
Sir, please, why are we deducting the 60 as a tax expense?
The 60, we are saving a cost of 200. Okay, this was a maintenance cost that you are saving. So if you are saving, it means that you are not going to be subtracting that cost from your profit again. So the profit of the 200, which should have been used to cover the maintenance cost, will now be allowable or will now be available for tax. Okay, so if you are making a profit of 600 and the cost that you are incurring first was 400, they will allow you to take the 400 from your profit. So they will charge tax on the 200. Now you are saving a cost of 200. It means that you only be subtracting this. So you now be having profit of 400, which they will charge tax on it. So the 200 will now be available for tax charge. So since it is a cash flow, you have to pay tax on it. Okay. I hope you are okay. You are okay with that. All right. Good. What is the total amount under the list?
So the present values will be
Okay.
year
Does it
3
mean
is 489.2 negative.
So I'm having 600. Three eight 4.8. Second year will give us 0.925 multiplied by 280. I'm having 259. So I'll have
The
280.
third one is 48.92.
So multiplied by 0.889. I'm having 248.92. So
The fourth one is 273.6 positive.
20. So this will be deduction 273.60. Okay, the last one will give us 0. Multiplied by 120. Okay, this will be 98.64. Okay,
Hello, Linus.
yes, please.
If we are not included the cost savings of 200,000 Ghana cedis, we would have charged the tax on it.
No, please.
Oh, okay.
Hello, sir.
Yes, please.
Please, the lease payment, if we are paying it now, why don't we enjoy the benefits the following year? Then you send it to the second year.
The benefit will be enjoyed in the manner how you are paying the tax. It doesn't matter how you are paying the lease rentals. Okay.
Okay.
The benefit
Okay.
is based on how you are settling your corporation tax. Okay. So don't be deceived by how they are paying it. Okay. The tax benefit will always be given in the manner in which you are settling your tax. We can't give you a tax benefit now once you are here to pay us now. The tax authority, they are not Ghanaians over here. They are white people. So you are owing me, you are here to pay, you are expecting me to give you a tax benefit now. Okay, so when you are paying your tax, that is the time that you take the benefit from it. So if you are coming to pay the tax, you take your benefit from it. So the tax benefit is enjoyed in the year in which you are paying the tax or in the manner in which you are paying the tax. So I'm having 273 points, okay, minus 98.64. I'm having 11. The cost of the lease is 1120.48. Is that correct? Okay. Okay. So I was saying that you can decide to ignore the cost savings because you'll be having the same effect on the two. But because of ticks, that's why we are bringing the two, because whatever be the case, the cost savings will be for the two options, and they are going to be having the same effect. You can see that we are bringing the 200 as cost, and we are taking a tax of 60. So it means that they are all going to be having the same effect as 200 over here, 140 here, 140 here, 140 here, and 60 over here. The same one like this. So you can ignore that one and bring only the ones that are related to this one, that are specific to each of them. Whatever be the case, the least option will still be the lowest, or in terms of cost, the least option will still be the preferred option. So the company should lease, because the cost of leasing, it is lower than the cost of you buying outright. As apart from the tax benefit, after tax cost benefit, why would a company also choose to, or why would a company choose to use leasing rather than buying? Why will a company choose leasing rather than buying? Apart from the after tax
Maintenance.
Okay, so the maintenance also, this is an operating lease, so the cost of maintenance will be, so, okay, so the risks of maintenance, and those things will still be with the risks of maintenance and insurance will still be with the lessor, because this is going to be an operating lease. Okay, this does not require initial capital outlay. Like, you are not going to be buying the assets. So we can avoid the 3,100, which is the initial outlay. It does not require. Okay, so prevent higher initial capital outlay. So does not require initial capital outlay. Okay, another one also. Another one also is that it can also come with with a flexible payment plans. Okay. It comes with a flexible payment plans, and also it can help the entity to utilize, or maybe surplus cash, the cash that we are going to be using to purchase the asset. We can use that particular cash for other activities. Okay, so the risks of maintenance and everything is being avoided. It does not require initial capital outlay, and also the assets might not be okay. So the reason is if the asset is purposely for that particular project, Okay, so we can choose this one for assets with no alternative use. Okay, so if we purchase the assets, and after the project life, the asset is not going to be having any alternative use. Okay, so it means that the assets will now become redundant over there, and the amount that we are putting into this particular asset will be something like a waste. Okay, so these are some of the reasons that a company can choose to lease rather than buying. Those are some of them. Please, any question? I want us to end it over here. You try the last question on your own, or tomorrow we can try it before we. So that is a question involving everything. Okay, everything that you have to know about investment appraisal, all the things that we have done, they are all advanced investment appraisal issues, sensitivity analysis. Okay, we have done MPV somewhere here and profitability index over here, but this is also about the advanced side, the replacements. We also have done the capital rationing. We done the sensitivity analysis, and we also did a lease or buy. So sensitivity analysis, lease or buy, and replacement are advanced ones. But this is a typical one. So initial investment, selling price, current prices, you just have to inflate them. So these are in current price items, current price terms. So it means that these values are all, they are all in today's terms. So the first year value, you have to inflate the first year value by 3%. Second year will be increment in the first year by the 3%. The same thing that we have done. The fixed operating cost will also be inflated, and the variable cost will also be inflated. Both of them will always be the 4%. Then if you count the demand 1 year is this and this, there's no issue with the demand over. Yes, please.
The variable operating cost, they didn't give the inflation for the.
It means that you are not paying, they say expected operating cost inflation, expected operating cost. So all operating costs must be inflated by 4%. Okay.
I thought it's fixed expected operating cost.
Oh, okay. So it is estimated that all units of the product produced will be sold in line with the company's policy of keeping no inventory of finished goods. No terminal value of machine scrap value is expected at the end of the 4 years when production of the product of the W33 is planned to end. For investment appraisal purposes, PV company uses what? Nominal or the money discount rate of this, and the target return on capital employed of 30% per year. Ignore taxation. Okay, so this is a situation where you have to ignore the taxation or the tax benefits, and also taxation on the depreciation. Okay, identify and explain the key stages in the capital investment decision-making process. So identify the investment opportunities, the screening of the idea, appraising, implementing, and also monitoring. Those 5 you have to. So calculate the following values for the investment appraisal: the net present value, the internal rate of return, return on capital, discounted payback period. Discuss your findings in each of the section, of B above, and advise whether the investment is financially acceptable. So you calculate these ones, it's not a big deal. So you can try that one. The only thing over here is the inflation. There is no issue about capital allowance. There is no issue about taxation as to the tax benefit that you'll be getting on the depreciation and those ones. So it's only about you inflating the prices, everyone. Whenever the prices are given in current terms, it means that these values are today's values. Okay, these are today's values. But cash flows are assumed to be arising at the end of the year. So if the price today is 26, what will be the price at the end of the year? So you just increase this by 0.3 multiplied by 20. That will be year 1. Year 2 will be 1.03 exponent 2 multiplied by 20. Or you can do 1.03 multiplied by year 1's figure at the end. Okay. So year 3 will give us 0.03 exponent 3 multiplied by 20. 1.03 multiply exponent 4 multiplied by 20. That will be for the selling price. Then you just come and multiply by the demand for each year. Sometimes they can also give you the inflation rate on the demand. You have to inflate them one by one. Okay. If you count to the variable cost, the variable cost will also be the 8 multiplied by 1.04 exponent 1, 8 multiplied by 1.04 exponent 2, 8 multiplied by 1.04 exponent 3, 8 multiplied by 1.04 exponent 4. If you count to the fixed cost, which is 170 per year. That is in current terms. You have 170,000 multiplied by 1.04 exponent 1, 170 multiplied by 1.04 exponent 2, 170 multiplied by 1.04 exponent 3, 170 multiplied by 1.04 exponent 4. Okay, so that is going to be about rolling that one. Apart from that one, you draw your cash statement, you bring your revenue, you bring your variable cost, you bring your fixed cost, you get your cash, the cash flow, then you now discount because there's no issue of taxation and there's no issue of depreciation. There's no issue of the scrap value also because the question is saying that there is no terminal value, which is the scrap value at the end of the useful life. Okay, please, any issue, I want us to end it over here so that tomorrow we look at working capital management, then we are done.
So the discount rate is
Yes, please, the least.
Is someone talking?
I said it's a
Yes,
discount rate.
Yes.
I can't hear anything.
I said the discount rate.
The discount rate,
Sure.
you don't have problem with. What is the discount rate? What are you talking about as a discount rate?
They said that they are saying that for investment appraisal purpose, PVCO uses the nominal money discount rate of 10% per year and a target return on capital employed of 30% per year.
So your concern is what?
My concern is the discount rate.
Which one do you want to use?
The 10%, but I'm not sure. That's what I'm asking.
Follow your heart.
Hmm?
Follow your heart. Okay.
The
Is
discount
someone-
is 10%.
Yeah?
I'm telling Benjamin that the discount rate you're supposed to use is 10%.
Okay. So the 30%
Okay.
for what?
The 30% is for invest return on capital employed.
30% the target ERR.
Okay. Thank you, Sina.
Okay, thank you. Yeah.
Yes, please.
Hey, Yima.
The lady talking,
Please,
your voice, I can't hear you.
I
I can't
wanted
hear
to
you.
ask something, please.
You want to?
Oh, can you hear me now? Hello, can you hear me now?
Yeah.
About the lease option, please, how did you get the 1-1? Your answer, please. How did you get it?
I just
The
present
lease
value.
option,
I
please.
just
Go
add
through that
the
one.
present value of those ones. So just discount these ones and these values, discount them and put them together. That is it.
When I said you're working,
Is that?
yes.
Discount them. Some of them will be positive, some of them will be negative. So put all
Well,
of them together.
I don't know. The one I have,
The one that you had is what?
yes, I know. So I the 600. Mind it, isn't not the 600? Isn't not negative 600?
Yes, please.
The three, I had positive of the 300. That's the year one. The year one, I had a 3 as the positive, as 3 points. The year two, I had negative 259, but you had positive. That's how come I'm asking.
The year one is negative. It's negative 400. Okay. So what I did that I make all the negative to be positive and the positive to be subtraction. If you do the same way, you'll be getting the same answer. So anyhow, year one is negative 384.8. Year two is 259 negative. Year three is 248.92 negative. Year four is 273.6 positive. But since the negative are all going to be adding, that's why I make it positive and subtract the positive now. So anyhow you do it, you'll be getting your 1120.48. Okay, so it's just a matter of addition and subtraction.
Right.
All right. So,
I'll cross check my figures.
okay, thank you. So tomorrow.